Hello, welcome to the Market Carver. I am Adam Harter, Chief Investment Officer, along with Zach Unger, our investment analyst, once again on for the second straight week. So glad to have him back, double dipping here, and expect to see more of him going forward, as well as Andrew, of course, and myself. So thank you, all of you, for chiming in. This week we got a few topics for you. A couple of big ones from the prior week. We're going to talk about the FOMC meeting that was last week. Then we're going to talk about maybe the way that path was laid, and then Zach's going to follow up with an interesting perspective in terms of this market condition, contrasting to consumer sentiment. So let's jump right in and talk about the path of interest rates. So as you're probably aware, at least most of you aware by now, Jay Powell did a pretty quick and pretty firm pivot from one where the Fed was raising interest rates to one where they're paving the path for lower rates in the future. What's really interesting is that just 2 weeks before, he had an important speech where he clarified that it was too soon to begin talking about rate cuts. But alas, at some point in time, they were going to open up that door, and they did so. And in conjunction with that, they give us, as they do 4 times a year, an updated look at their projections. And so we'll unpack this chart that you're seeing. The blue line is just that, the FOMC's prediction for where they think rates will be next year. And what they include is 3 rate cuts. So they think we'll go through the first part of the year where we are holding steady, but that they will begin to need to ease off of that going into the end of next year. So time will tell whether that's going to turn into one cut each quarter, and certainly that will evolve. But for now, that is the outlook. The other 2 lines, and this is a little bit of extra interesting commentary. So the gold line was the market's expectation. So at any point in time, futures traders can have bets on where they think rates will be. That gold line was the market's expectations. And so the Fed's updated look essentially walks down and met the markets. But meanwhile, the red line then fast forward to after the meeting. So essentially the market saw that the Fed was coming down, and they immediately began to price in more cuts, up to actually 6 cuts next year. So we'll see whether it's 3 or 6 or something different altogether, but that is the outlook as of now. And of course, assets quickly repriced to that, including the stocks and bonds and gold and everything else. So the path leading up to that can be found in inflation. That's really been the changing dynamic. So the Federal Reserve, just your general background, they've got a dual mandate, and that is to have price stability, i.e. inflation around that 2% target, and maintaining full employment. And so typically they'll have to sacrifice one to get the other. At least that's the Fed's framework. It doesn't always work that way in the real world, and oftentimes that's in a good way, and that's what we've seen now. Inflation has come down as they've raised interest rates, but we have maintained full employment. So this next chart will show you how this inflation environment has changed. That has continued to calm down. The purple line there is the CPI on the right panel, and the blue line is what we call the core CPI, backing out the more volatile components. And that has continued to stabilize. We're not yet down to a 2% inflation rate, but the trend is very firmly down. And more so. So the biggest component of inflation is shelter. Far and away, that is the biggest component, as it is for most of our household prices. That's the biggest weighting. And there's a lag effect. It takes time for changes in shelter costs to filter through into the way we officially report it. So the official numbers are at 3%. But we expect that to continue to adjust. One of the easiest ways to think about why there's a lag is that most renters operate off of an annual lease rate. So they don't have that shifting each and every month. We get an updated CPI report. So there's a lag effect. And you can see that on the left panel. So the purple line is the housing inflation that feeds through to the official reports. And you can see often beating that to the punch is an updated list. So here specifically, we're just looking at Seattle. It's easy to just take a look at one city's change in inflation. You can see that it fell into the pandemic in the early part of that, but then it rebounded sharply into the 21-22. Housing and shelter began to filter up, but now we've seen a rapid decline that should continue to feed through in a negative way. So all that saying, it's very confident, and the Fed's very confident that we're on a path to 2%. And As with anything else in economics, that is subject to change, but that's the path that we're on for right now. Zach, I will turn it over to you to cover the consumer sentiment piece.
We've got a chart here of the University of Michigan Consumer Sentiment Index. Measures sentiment around things like economic activity, economic outlook, personal finances, business outlook, etc. It's one of, if not the most widely recognized measures of consumer sentiment. And you can see there, most of 2022, we spent at record lows for this particular index. And even still, at that 69.4 level, are below levels that we have seen since dating back to November of 2011 would be the last time that we were this low, 2022 notwithstanding. The contrast that's really fascinating is consumer sentiment remaining very, very low, despite the average stock being up double digits this year. So a relatively strong market and still a skeptical consumer, which does make some sense. I've spent the majority of the past 18 months with headlines predicting impending recession, elevated interest rates, and the Fed going through a hiking cycle, as well as elevated inflation, as Adam laid out. But the swift pivot from the Fed, setting the stage for rate cuts, many potentially next year, as well as inflation coming down. As Adam noted, we may see this consumer sentiment start to increase. The effect of that in terms of how it plays out in the overall economy, consumer demand, things like that, and how it turns into economic strength remains to be seen. But a sharp disparity between how consumers feel about economic outlook and their own personal finances and businesses versus how the market has actually performed this year. So interesting disparity. We'll see if those start to come back together in tandem sometime soon.
Yeah, truly wild, and it's something I could say there's without precedence in my career, perhaps if you go back, but just such a wide disparity between how things are actually performing in the economy and people's perceptions of it. So very well put, Zach. Appreciate you being on. Thank you to all of you. As always, we'll give you a reminder to give us a call if we can be of service, 800-928-4001, or scan the QR code to book it electronically. And we will certainly take this opportunity to wish you a very Merry Christmas. So between now and when we get back together, hope you all have a wonderful time with your families and have a great weekend.